Housing prices are close to all-time highs. In fact, they're way higher than they were at the peak of the last bubble in 2006. And if you listen to the mainstream media, they'll tell you that prices are going to continue to go higher forever. This time, it's different. But you and I both know that is unrealistic. And I think there's a potential black swan that's out there lurking that could bring prices down to a level that most people think is unimaginable. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over adjustable rate mortgages. These were the financial time bombs that almost took down the entire global economy back in 2008 and 2009.
One of the problems is people do have a lot of mortgages tied to floating interest rates.
Now these adjustable rate mortgages, or ARMs, are back, but not really in the way you think. Let me explain. Let's check out a chart going all the way back to 2005 to 2008, 2009 or so. On the left, we go from 4% up to 6.5%. These are interest rates, or were interest rates, for adjustable rate mortgages back then. This one in particular is fixed for 5 years, but then every year after that, it adjusts. So back then, 2005, right around 5%, you guys know what happened. The Fed increased interest rates. So then when those mortgages adjusted, people had a lot more money out of pocket. They couldn't afford it, and all those properties went right back to the bank. The rest is history. But look at how much the rates actually went up. On these, they went from 5% up to about 6.5. Not that much. Only about 1.5%. Now, I do want to point out that they were a lot lower in 2004, 2003, but unfortunately, the chart from the Federal Reserve that I'm using doesn't go back that far, but we can pretty much guesstimate what the interest rates were and how much the increase was by looking at Fed funds and the 30-year. I did some quick back-of-the-envelope math, and we'll say the delta between the 30-year and this 5, we'll call it 5 over 1, I'm not sure how the pros say that, but we'll call it the 5 over 1 ARM. The delta was about 2%. So what this meant on a typical mortgage is the increase in monthly payments was about $400. And I came to that number using a mortgage calculator, starting with 4.5% interest rate and then going up to a 6.5% interest rate. So there were a lot of reasons why we had the GFC, but no one would dispute that these adjustable rate mortgages were a huge contributor to the problem. But it wasn't just the ARMs. It was the fact that people had to take more money out of their pocket every single month, and that was money they couldn't afford. So it got to a point where they could no longer afford the cost of ownership, and therefore they had to default on the mortgage. They sent the keys right back to the bank. The bank has them on their balance sheet, and this was the start of the GFC. And I know a lot of you right about now are saying to yourself, oh, George, I don't even know why you're going over this. This is completely ridiculous. Because right now, pretty much every single person out there has a 30-year fixed rate mortgage. So these aren't even applicable anymore. In fact, this is one of the main reasons why the housing market or real estate prices are going to go up forever. Because people have this low mortgage payment every single month that's locked in for 30 years. So they don't have to worry about what Jerome Powell does. He could take interest rates straight up to 20%, like we saw in the late 70s or early 80s, and it wouldn't matter to them. Well, here, my friends, is the flaw in that argument. Let's look at another chart going back to 2020 to today's date. And I got these numbers straight from CNBC. And it was an article that was talking about how much the cost of home ownership has gone up outside of the monthly mortgage payment. So things like property taxes, insurance, and maintenance. And back in 2020, the average annual cost out of pocket to maintain your home was right around $14,000. Again, remember, these are costs minus the mortgage. This does not include the mortgage payment. But what happened in 2021 and 2022 were the prices of everything went parabolic. So now what happens is the average, if we fast forward to today, the average cost to maintain your home outside of the mortgage is $18,000 roughly. It's gone up by $4,000 a year. In other words, the average homeowner out there has to come out of pocket every single month right around $400. The exact same increase that we saw that contributed to the GFC. And this is the real key that we have to understand. It's not just about a mortgage payment. In fact, at the end of the day, the mortgage payment isn't really what's relevant. What's relevant is how much money you're taking out of your paycheck to put into your house. It's just like an employer who has all of these employees and the cost of their health insurance goes up. Well, you don't really care if it's the cost of health insurance going up or the wages. The bottom line is you are having to take more money out of your bank account to make sure that you can keep that employee. Whether that additional cost comes in the form of A or B, you don't really care because the net result is exactly the same.
Step number 2. So what we learned from step number 1 is it's not just about your income versus your mortgage payment. It's more so about your income versus your overall expenses. And it's not just your housing expenses. It's your cost for your car payment. It's your cost for energy. It's the cost to put food on the table. Let's go into a recent chart that shows how wages have been keeping up with the rate of inflation, or maybe better said, have not been keeping up with the rate of inflation. On this chart, we can see wages and price changes from a year prior, so year over year. And what I want to focus on is the dotted line. This is the overall CPI. And keep in mind, this is the number that the government admits to. I would argue that the real rate of consumer price inflation is much higher, although the trend is most likely accurate. And then we look at hourly earnings or weekly earnings. Now, going back to 2022, the rate of consumer price inflation, as the government would admit to, was way higher, way higher. Look at this. It peaks out right around 9.1%. I believe that was in June or July of 2022. At this time, hourly wages were going up right around, we'll call it 5.6, 5.7%. Weekly earnings were only going up around 5%. So there was a huge delta here of, say, 3 or 4%. So if you compound that year after year after year, then pretty soon you get upside down and your purchasing power. That's what's most important. Your purchasing power is declining even though your income and wages are going up. And when I mean you, I'm talking about society as a whole, the average Joe and Jane. But then when you fast forward to, let's say, the middle of 2023, then we see the CPI going down to a point that was under hourly earnings and, for the most part, weekly earnings. But here is where the devil is in the details. Let's go to another chart, because looking at just this, it would lead you to believe that, well, yeah, the consumer and the average Joe and Jane, they had it rough during 2022, but they've had it pretty good from the middle of 2023 to today. But this is an inaccurate conclusion, especially when you're looking at it through the lens of the housing market. Now, let's get over to the other chart that I was referring to. And this is from the Atlanta Fed. And it breaks down the wage increases by age. This is crucial. So, what the last chart was showing us is just the total of all the wages combined, regardless of the age group. Well, here we can see that there were massive discrepancies. Look at this green line. This is the age group 16 to 24. The majority of the wage gains that we saw in 2021, 2022, and in fact, pretty much from 2020 to today's date, have been in the younger demographic. In other words, people that don't own homes. When you look at the typical age range for someone that owns a home, let's just say 35 years and older, you see that their wages, although they did go up slightly, they didn't go up near as much as that younger demographic that most likely doesn't own a home. So when we go back and look at that last chart and we try to isolate the homeowners, I think it's fair to say that the majority of them have seen their purchasing power decline, not just in 2022 and into 2023, but pretty much from 2020 all the way to today's date. In other words, their income hasn't gone up at the same rate as their overall expenses, not just their housing expenses. So the main takeaway for step number 2 is if your income is only going up by, let's say, 5% per year, but the cost of food is going up by 20%. The cost of health insurance is going up by 15%. The cost to put your kid through school is going up by 30%. That means there's even less money to go to your housing costs. So even if you have that mortgage that's the exact same payment every single month, if all the other out-of-pocket costs that you have, including your property taxes, your home insurance, your maintenance costs, if they're all going up, it gets to the point where you're completely underwater. And the only thing that you can do is sell your home because fortunately, you've likely got some equity to bail you out. But what that does is that increases the supply of homes that are for sale on the market. Well, right now, we have incredibly low demand. So if you increase the supply of homes for sale, what does that likely do to prices?
Step number 3. Now let's go over the SOM rule, which is a very powerful indicator for recessions. So in step number 1, we learned that housing costs overall going up, putting more pressure on homeowners, but it's not just the housing costs. We learned in step number 2 that it's the overall purchasing power has been declining rapidly. But what happens if we go into a recession? So let's go back first and foremost to January 2023 on this chart. We go to today's date. On the left, we go from 3.3% up to 4.2%. This is the official unemployment rate. And this is where we get into the SOM rule. So this rule, we'll go to Investopedia, editor, why don't you go and throw that up, shows that if you go back to the 1950s, almost every single time the 3-month moving average of the unemployment rate increases by at least a half a percentage point, it not only shows that you're at the beginning stages of a recession, but it also shows the unemployment rate is likely to go much, much higher from there. And if we look at a long-term chart, we can see how this has played out in the past. Almost every single time the U.S. has gone into a recession, we see it preceded by an uptick in the unemployment rate. So that begs the question, what is the unemployment rate doing right now in 2024? And how does this apply to the SOM rule? Are we in jeopardy? Are we getting close? Well, back in January of 2023, the unemployment rate bottomed out around 3.4%. We see the same thing here right around, let's call it March. But since that time, the unemployment rate has gone from 3.4% all the way up to 4%. So this would be an increase of not just 0.5%, but 0.6%. So even though this powerful recession indicator is a 3-month moving average, we can safely say that it has definitely been triggered. So the key takeaway is this increases the odds of us going into a recession, if not being in a recession right now. It also increases the odds of the unemployment rate going a lot higher. We're at 4% right now. Well, what happens to people's purchasing power let's say, when a lot of people are losing their jobs? It's an easy question to answer, isn't it? So their purchasing power goes down, which exacerbates the problem of all their other costs increasing, which puts even more pressure on them to do something. They're just waving the white flag. They can't take it anymore. So most likely, one of the options they'll have on the table, if they have equity, which a lot of people do, is to sell their home. Now, right about now, I'm sure a lot of you are saying, well, George, they could always just extract that equity through a home equity line of credit or maybe taking out a cash out refi. Well, right, but then they have an additional monthly payment. And keep in mind, the reason they're selling is because they have too many monthly payments as it is. So this doesn't really bail them out. I would argue it might kick the can down the road, but it makes the problem even worse. Let me be very clear. I am not predicting that the housing market is going to crash by 20, 30, 40, 50% like we saw back in 2009 to 2012. But what I am saying is there are some severe risks out there that most people aren't paying attention to. So when you're considering buying or selling, or when you're considering a home as an investment, you have to compare it to other investments, and it's all about the risk reward. And now the risks are not only higher than they were in, let's say, 2023, but the risks are increasing every single day. Consumer prices continue to go up while consumer incomes lag behind. So what is this black swan specifically that I was referring to at the beginning of this video? Ironically enough, it's actually inflation. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.